Well, good morning, and yes, here I am at the crossroads of the world, Grand Central Terminal in the heart of New York City. And today is Monday, April 29th, 2024, and here are the things that you need to know to get your day started in the markets, right? So, I guess we're going to talk about the verses of life, right? 녕cerà, Sera, exactly what Doris Day sang about in 1956. Stocks ended the week higher thanks to Google and Microsoft's earnings reports on Thursday night and into Friday. And will this week bring the same enthusiasm as we saw last week, while stocks and bonds continue to thrash around as they try to interpret the Fed's next move? We're going to have more earnings this week and lots of economic data to drive the action all week. Oil and gold are holding steady as they have over the last couple of weeks. And what we have for dinner tonight, we're going to try the Seared Halibut and an orange and lemon butter sauce. It is delicious. Okay, so do you remember this? When I was just a little boy, I asked my mother what I will be. Will I be handsome? Will I be rich? And here's what she said to me. 녕cerà, Sera. Whatever will be, will be. The future is not ours to see. 녕cerà, Sera. It will be what it'll be. Doris Day sang that in 1956 in the Alfred Hitchcock film, The Man Who Knew Too Much. Now, the three verses of the song progress through the life of the narrator, right? From childhood through young adulthood and into falling in love and then parenthood. And at each moment, he asks, what will be or what lies ahead? The chorus repeats the answer. What will be, will be. Okay, and so you ask, what will it be? What lies ahead for the markets? And the answer to that question, we must consider what lies ahead for earnings, for the Fed, for inflation, for the conflicts in both the Mideast and Russia and Ukraine, as well as the brewing conflict in the South China Sea. Think Taiwan and China. And so, in the words of Doris Day, 녕cerà, Sera. Okay, on Friday, stocks and bonds ended the day on an uptick as the Mag 7 came to the rescue. The gains amplified by Google and Microsoft after they reported blowout numbers and offered robust forward guidance. The demand for AI and cloud services is taking all the headlines, and really, that's all you need to know about what happened on Thursday night into Friday, right? At the closing bell, the Dow had gained 154 points, or 0.4%. The S&P up 52 points, or 1%. The Nasdaq surged ahead by 316 points, or a whopping 2%. The Russell added 20 points, or 1%. The transports has bucked the trend, which has been the case, got slammed, right, falling 126 points, or 0.8%, while the equal weight S&P gained 9 points, or 0.2%. Right? The advance came despite the fact that the latest PCE deflator report, right, the Fed's favorite inflation gauge, remains, let us know that inflation remains sticky. It continues to advance on a month-to-month basis while declining ever so slightly on a year-over-year basis. And while they tell you to focus on the year-over-year read because it fits their story, it is the month-over-month reads that we need to concern ourselves with, because that data point dictates what is happening right now in our everyday lives. And what we know, and what many has feared, is that inflation remains stubborn and somewhat hot. Period. The end. The idea that the Fed is going to cut multiple times in 2024 is all but a pipe dream. Holding rates steady is probably the best we can hope for, while the possibility of a rate hike would be a nightmare. And while the odds of a rate hike are slim, they're not zero, right? And why? Because the month-over-month numbers have turned up, right? Over the last 3 months now, we've seen that, and that starts to make a trend, right? 1 month, maybe not, but 3 months does start to make a trend. The darkening outlook for any rate cut has managed to push bond yields up. The 2-year now kissing and piercing 5% a couple of times last week. And this morning, bonds have settled down just a little bit with yields backing off. The 2 years yielding 4.97%, the 10 years yielding 4.62%, the TLT and the TLH, which are two popular bond ETFs, though they continue to struggle, right? Remaining down 10.7% and 8.5% respectively year to date. The broader AG index, which is the AGG, it's the iShares Aggregate Bond Index, which includes investment grade, U.S. Treasuries, and corporate bonds, along with mortgage-backed securities, asset-backed securities, and CMBSs, is, in my opinion, a better way to give yourself bond exposure that is not really as nearly as concentrated as the TLT and the TLH. And that is evidenced by the performance this year. The AG is down only 3% year to date versus the other two. Now, shorter duration bonds, 3 and 6 month bonds, are well within the 5.45% annualized rate, while 12-month CDs are paying you nearly 5.5%. You see, the bond market is now waking up to the idea that inflation is not going away anytime soon, and that is keeping rates higher for longer, and that continues to cause volatility for both stocks and bonds. Having some investors opting out for the safety and no risk, while others view the drawdown in stock prices as a long-term opportunity. But then I say the TLT is down 10.7% year to date. So how can you say there's no risk, right? How can I say there's no risk in owning the TLT? Because if you've moved your money into US Treasuries, physical treasuries, then you don't care about what they do on a daily basis. You bought them for the coupon and for the safety. You're not trading the bond. So any loss in the bond during its life is irrelevant to you, right? It's a paper loss, not a realized loss, because you're not selling them. Once they mature, you're going to have gotten all your payments and 100% of your money back. So you've lost absolutely nothing. Gavish, in the end, because you lost nothing, maybe an opportunity cost, but that's a whole nother story. Now the VIX, which has been trading in the 12 to 14 range, which is relatively complacent for 3 or 4 months now, has steadily risen over the last couple of weeks, trading as high as 21 last week on the day that we saw the market get smacked, right? That's up nearly 60% from where it had been trading. Now, it ended the week at 1540. Yes, below the spike up, but still ahead of where it's been for the last 3.5 months. And remember, the VIX is the fear index, and so it's all about what investors and traders feel. And the recent rise in the VIX suggests that fear is building. The VIX is now up 17% year to date, while the S&P is up 6.5%. But remember, the S&P was up 10.7% coming into April when fear started to build. So fear went up and then the market backed off. In the end, the aging economic cycle and the stocks that are facing renewed headwinds make Doris Day's 1956 classic a fitting analogy for today's commentary. Recent volatility aside, stocks have performed incredibly well over the past 5 months, with the S&P total return gaining about 25% off of those October lows, right? That was through last Friday, while also posting the best first quarter since 2019. Demand for stocks is being driven by the continued momentum for some of the Mag 7, think AI, but also by the broadening appetite across all the sectors, and we've discussed this. The official S&P group rank returns versus the S&P ETF sector ETFs shows us that communications is leading the pack, up 17% year to date, followed by energy up 14%, financials up 8.5%, tech up 8.3%, industrials up 7.8%, consumer staples up 5.8%, basic materials up 4.4%, utilities up 4.4%, healthcare is up 2.5%, consumer discretionary is only up 1% year to date, while real estate is this year's underperformer, down 9%. Now, it is the broadening performance that's really the bullish indicator, even as the markets have come under pressure due to renewed upward pressure on inflation, escalating global conflict, and the realization that the Fed has become less supportive of multiple rate cuts, right? As the last few weeks have demonstrated, investors are a bit edgy, and so I say find some shelter in the storm. And at this moment, that's the solid earnings season that we are currently in. Now, the first quarter earnings season has really kicked into high gear, right? Last week, 37% of the S&P reported results, just last week alone. And that now brings us to about 50% of the S&P having reported. 81% of those reports have beaten the estimates versus the usual 74%. And the magnitude at which they have beat is running at a healthy 7.8% versus the usual 6.5%. And do not dismiss the fact that the stakes remain high. Valuations were stretched. We talked about that. Maybe a little less so now than they were, but they were stretched, despite an overall climate that continues to challenge corporate profitability. Navigating these challenges will be key if the markets are to regain their footing and investors are to feel less fearful. But as Doris Day sang, ḥěřejǒ, Sera, right? At this point, with half of the S&P having reported, the view is that the earnings season has once again been better than expected. As of early April, consensus expectations were for a flat first quarter year-over-year earnings growth and a 3% year-over-year revenue growth, representing a substantial decline from the mid-single digit growth that we saw in the fourth quarter of 2023. As of Friday, though, the data and consensus expectations are now suggesting a 4% earnings growth year over year and a 4% year over year revenue growth. And that ain't so bad, given all of the concerns that are swirling around us. All in, the solid fundamental performance that we are seeing does provide the long-term investor with some shelter from the storm. But do not become complacent. Sticking to your plan and remaining disciplined continues to be the way forward. Now, oil continues to trade in the mid-80s, currently trading at 83.60, while gold tested lower at 2,300 last week, but bounced, as we talked about, and this morning gold is up $7 at 23.54 an ounce, something we have discussed ad nauseum. Now, while both of these commodities are sensitive to monetary policy, they are also very sensitive to the global politics, right? And the global conflict. And I ask, do we need to go there right now? Or do you guys get it? Do we understand what's happening around the world? I suspect oil is going to remain in the 80-90 trading range, and gold is going to remain in the 2,300, 2,400 trading range. This morning, it is a new day. U.S. futures are up, right, on the back of the strong week last week. Dow futures are up 35, the S&P's up 6, the NASDAQ was ahead by 40, and the Russell is up 2. This is going to be another week of a lot of earnings, key economic data, and the Federal Reserve FOMC meeting, which starts tomorrow and ends on Wednesday. Eco data today includes the employment cost index, right? Expected to be up 1%. The Commerce Board consumer confidence, ADP employment comes out on Wednesday. It's expected to be up 180,000 jobs. S&P manufacturing PMI of 49.9, slightly contractionary. ISM services PMI of 52, that's expansionary. Construction spending up 0.3. ISM prices paid, think inflation. And on Wednesday, we're also going to get the Fed rate decision. By now, we all know that they are not cutting rates, but nor are they raising them. And on Friday, we're going to get the all-important non-farm payroll report, and that is expected to show an increase of 250,000 new jobs. Average hourly earnings month over month up 0.3, and year over year up 4%. Unemployment holds steady at 3.8%. Earnings are due from such stalwarts as Apple, McDonald's, Coca-Cola, Amazon, Domino's Pizza, ConAgra, Triple M, PayPal, Eli Lilly, Air Products, and a whole bunch more. European markets this morning were mixed. Spain was up 0.5%, while Spain was down 0.5%, while the UK was up 0.5%. Investors there are going to focus more on European earnings as well as on the Fed policy statement on Wednesday, as so many will use that as an indication about what they may hear from the ECB and the Bank of England at their next meeting. The S&P closed at 5,099. It was up 52 points. I continue to believe that we're in this 49.50 support, 51.20 resistance trading range. And while it feels like the market wants to push higher, I am still in the camp that we're going to test trendline support at 49.50 before we test trendline resistance at 51.20. But this week could prove me wrong. Investors need to see ongoing better earnings and better guides to continue if we're going to break up and through the 51.20 resistance level, right? Keep your powder dry for now. We've talked about this. Let this volatility settle down. Stay the course with the names you own, unless, of course, the fundamental story has changed, right? Your cash, if you hold cash and you got it invested in a money market account, it's earning 5+ percent, 5.25 maybe, as long as you have it in that interest-bearing account. As a long-term investor, again, you need to eliminate the noise and focus on the plan. Discipline is key. As a short-term trader, you want more noise. You want all the noise you can get, right? So at this point, you have to decide who you are. Are you a long-term investor? Are you a short-term trader? Call me to discuss. I'm happy to help you put it all in perspective and put a plan in place. Okay, so what are we having for dinner tonight? We're having the seared halibut in an orange lemon butter sauce. This is simple to make. I know it sounds complicated. It is not, right? Halibut's a great fish to cook. It's a white fish, it's flaky, it takes any number of dressings to kind of help it out, because it doesn't really taste like anything, it's the dressing that makes it, right? Today we're going to sear it in a little butter and olive oil, and then roast it in the oven until it's nice and tender. When serving, you want to drizzle some homemade orange lemon butter on top of it. Sound good? Okay, let's go. For this, you need 2 pounds of halibut, you need butter, olive oil, and salt and pepper. For the sauce, you're going to need fresh squeezed lemon juice, fresh squeezed orange juice, shallots, white wine, and butter. Now, begin by adding the juice of the lemon and the orange into a saucepan, right? So squeeze them, get them into a saucepan, heat it up, and then reduce it by half, right, over medium heat. Then just set it aside. Don't do anything with it, just set it aside. Preheat your oven to 400 degrees. Now, take the halibut, season it with salt and pepper. in a saute pan, a different saute, now in a saute pan, heat up a dollop of butter and a splash of olive oil. When it's nice and hot and sizzling, you're going to add the halibut. You're going to sear it nicely until golden brown on both sides. So do one side and then flip it, do it to the other side. Remove it, now set it in a roasting pan and place it in the oven for maybe 15 minutes or so. Again, it depends on how thick it is, so you're gonna have to wing it here, right? While this is cooking, get another saucepan out, add in a half a stick of butter. Turn the heat up and melt it. When it's all melted, you're gonna add in the sliced shallots and you're gonna saute it. Now add in about 3/4 of a cup of white wine and then cook that until it's reduced by half. Turn the heat to simmer. Add in another tablespoon of butter and then whisk it, right? When it's incorporated, add another tablespoon of butter and whisk it, right? Continue this for 2 more tablespoons of butter. Now, slowly add in the lemon and orange juice and keep mixing it and then just set it aside. Now, when it's ready, take the halibut out. This looks great on a bed of sauteed spinach. Place the halibut right on top of the sauteed spinach and spoon that sauce that you just created over the top of the halibut. It is delicious. Serve this with your favorite white wine. Naturally, you can use the white wine that you use in the sauce. And for me, you know what that would be, the Pinot Grigio Santa Margherita. In any event, it is Monday and I am in New York City until Wednesday. Until tomorrow, take good care.